Credit cards. When used properly, they can work as a powerful financial tool. Likewise, using a credit card improperly can wreak havoc on your finances. The following video will aim to clear up the mystery surrounding credit cards. A credit card is a small plastic card that extends a temporary loan anytime a consumer uses it to make a purchase. If the loan or charge is paid back within a specific grace period, usually between 21 and 30 days, one does not have to pay anything above the amount you initially charged. It amounts to a short-term, interest-free loan. Credit card interest is generally charged as a percentage of what you'll owe each month. The percentage of interest you'll owe each year is your annual percentage rate, commonly referred to as your APR. Your APR may be anywhere from 0 to 24.99%, depending on your personal credit profile, credit history, or credit score. But since months aren't all the same length, most card issuers use a daily periodic rate, or DPR, to calculate interest charges. To find out your daily periodic rate, you simply divide your APR by 365. There are two main types of credit cards, secured and unsecured cards. Unsecured credit cards are the most common type of credit card. They extend a line of credit that is not secured with a deposit. That means that each time the card is used, the bank is loaning you money without collateral. Unsecured credit cards are for consumers with good or excellent credit. Secured credit cards, meanwhile, require a deposit as collateral for a line of credit. In some cases, the deposit can even be equal to the line of credit itself. For example, a $500 deposit might allow you to charge up to $500 on the card. If you fail to pay back your bill, the bank may keep the deposit. Secured cards are for people with poor credit. They can qualify for a credit card and improve their credit score. Using a credit card can be advantageous or disastrous for your finances. It all depends on whether or not you use that credit responsibly. Here are some of the pros and cons for credit cards. Credit card pros include flexibility. With a credit card, you can make large purchases and spread out the payments over time. At the least, you have until the next billing cycle to pay off a purchase before owing interest. Convenience. A credit card can provide a line of credit you can use instead of taking out a loan at a bank. Using credit can also be a lot more convenient than carrying a lot of cash, and is often the best, or only, way to make a purchase online. Rewards and benefits. Credit cards offer a slew of rewards and perks you can't get anywhere else. These rewards can include everything from cash back on your purchases to free flights. Build credit. Establishing a good personal credit history is important. Your credit score can impact the interest rate on your car loan and mortgage. Using a credit card responsibly over time is the most straightforward way to build good credit. Cons of credit cards include debt. Unlike other forms of payment, using a credit card can get you into debt, sometimes enormous debt. Misusing credit cards can also wreck your credit quickly. Risk of overspending. Using credit instead of cash can cause you to dissociate your credit spending with the money you actually have, a phenomenon that can often lead to overspending or careless purchases. Interest. If you carry a balance, even small amounts of interest can add up over time, meaning you'll end up paying far more than the retail price on your purchases. When you know the various ways credit card companies make their money, it can help you try and keep your money out of their hands and in your own pocket. Typically, credit card companies make their money in 3 different ways. Interchange fees. Consumers don't pay these fees directly. Rather, every time you use a credit card to buy something, the merchant or the vendor pays a percentage of the sale back to the card issuer. In most cases, 1 to 3% of the purchase. Credit card interest. Just as banks earn money by charging interest on their car loans and mortgages, credit card companies charge interest when you don't pay back their loans right away. User fees. Card issuers also charge a slew of fees to various users based on their card policies and their unique circumstances. The most common fees include annual fees, late fees, over-the-limit fees, balance transfer fees, and cash advance fees. Although many credit card users pay some or all of these fees at one point or another, most are completely avoidable. Understanding credit cards is very important in order to be financially successful.